you. Good morning, all of you. Thank you so much for taking the time out to attend this session. I hope there is some takeaway at the end of this, and I'll be happy to answer any of your queries. So this topic is primarily the intent behind having this topic for the webinar is to provide broad guidelines to each one of you on how you could manage the financial aspect of your life. It's a phase where you're going through a lot of reset in probably in every area of your life. So there are simple ways, easy ways in which you can at least have control over this particular aspect of your life, and that is our intent. It will be broad guidelines that we will throw because each one's situation is different, each one's circumstances is different, what you have gone through is different. So we will provide pointers on how you can manage your finances better, tweak it better so that you don't have to depend on anybody else and you manage to successfully achieve the financial independence goal. So the objective behind this webinar, this is both for people who are currently financially independent as well as not financially independent, as we understand that many of you may have been thrown into this particular situation, who wish to pull it through without family backing. Financial planning is no rocket science. So it is a structured process, and you may hear me repeat this particular term again and again. And it is as simple as that. It is just a structured approach. Initially, you may have to put in that effort, time to bring in the processes into your financial planning. But once it is in place, it is only discipline and consistency that will see you through. That is true for whether you're a single parent or otherwise, but applies a lot more in the case of a single parent. So finally, we will end the session by highlighting areas where people can go wrong. People need to be wary of and watchful, like your debts, your credit score, or your asset allocation. Okay, so these are the broad pointers. So when do you become you may be a single parent either by choice or because of circumstances. It could be any one of them. So when you opt to be a single parent by choice, it's a conscious decision. You may be financially ready, and that's why you opted to become a single parent, because you can manage yourself as well as the beautiful child that is going to come into your life. So if it is by choice, the areas that you would be working on would be slightly different. You need to start planning for the different corpus, your retirement, your child's education. You'll need to focus on risk management, succession planning, will management. So because you're comfortable on one area of your life, the areas you would be focusing on would be slightly different. The other scenario is where you are a single parent, either because of life circumstances, either there is a separation or an unfortunate demise. So this area of life calls for a bigger reset, in my opinion. Having said that, I don't mean to undermine anybody's life situation or processes. So that in this particular scenario, it is possible that your finances may be in disarray. You may be having debts. You need additional income. That you need some further income support, and there may or may not be some kind of a family backing. So in this particular scenario, in the areas that you need to work out are create income sources, look at ways in which you can align your debt, especially if you are joint holders, relocation, you need to budget, manage your household expenses. So there are a lot more areas that you need to be focusing on. So our approach over the next 35-40 minutes will be to specify areas which are non-negotiable, whether you are financially independent or financially not independent, whether you're a single parent by choice or a single parent because of life circumstances. The first part of our webinar will focus on the 4 areas where you have to address it at the beginning itself. Your investment process, your financial process will come at a later stage. I would also like to state that financial planning by itself is a very vast topic, but we have just touched upon a broad sense of direction and guideline on how to go about it. So what are the non-negotiables for every single parent, whether you're by choice or by life circumstances? These are the four. The first is a health cover. Second is a life cover. Third is nomination. And fourth is will. Please address these four areas of your life, because how you manage your finances will pan out over a period of time, but at least what you manage to accumulate, what you manage to do will be preserved will because of the steps taken under these four. So we'll cover it one by one. I'll first take health cover. Okay. So if we all know, we all are aware that health inflation has been one of the highest amongst the different expenses or different items of expenditure. As per a report by Plum HQ, it came very recently, health inflation over the last 1 year was at 14%. That's a steep increase. We also get to see through, because of our clients who some family member is admitted, typically they tend to exceed the health cover if it's a serious ailment. So the number one thing that you need to do as a single parent is ensure that you take a independent policy, even if you have through your organization, in case you're working, please take an independent cover of at least starting 5 to 10 lakhs. For over and above that, you can take a simple super top-up policy. Those who wish to understand this more, you can reach me and we will explain. A super top-up basically at a much lower cost covers a higher cover. So if you take a 10 lakhs cover, you can take a super top-up for up to 50 lakhs at a very minimal cost, so that in case your health expenses exceed 10 lakhs, it can be met by the super top-up. Okay. So number one, have an independent cover. Second, if you wish to further increase it beyond 10 lakhs, 10 lakhs is the minimum that one should be having in today's scenario. If you wish to exceed more than 10 lakhs, please take a super top-up. It should be, you can take a floater policy for yourself and your child. While you're taking a health cover, evaluate a reinstatement. Reinstatement means if you have exhausted the cover in a particular year, see if that particular provider helps you reinstate to the same amount. Like many of these vendors, if you've taken a 10 lakhs and you have exhausted it, they will again reinstate 10 lakhs, another 10 lakhs at no additional cost. So the terms that you should evaluate is reinstatement and no claim bonus. Okay. If you are working in a company and your company is providing group health cover, please go for it. The cost, it's a much more cost-effective way of having a health cover. Typically, companies give anything from 2 lakhs to 8 lakhs and 10 lakhs, and many bigger organizations provide you with an option to top it up at a very minimal cost. Understand that this will any day be more cost-effective for you than taking an independent cover. So first opt for a group health cover. Over and above that, make sure you have an independent cover. You can, if you wish to help any single parent from the lower sections of the economy, you can suggest to them plans like Ayush. Ayush is not given for all. It is given provided you provide certain certificates or proof that you fit into this particular category. Please opt for Ayush. The premiums are extremely low and you get a cover of about 5 lakhs. Very recently, there are a few vendors with whom we work. They have started offering monthly premium options even for health cover. Not all of them. This is not a established trend even now, but there are a few vendors who provide monthly premium options. Okay, so health cover is mandatory. This is the first non-negotiable for a single parent. The second is life cover. So once you've, because health is, why we have put health before life is, health emergencies could happen when you are around, and up to a limit, even if you have a family, it is easy for somebody to pitch in. Beyond a point, it is difficult for everybody. So make sure you are responsible for your health emergencies. Second is life cover. So being the sole breadwinner, as I mentioned at the beginning of the session, a lot of this is the points that we have put is keeping in mind that you wish to manage everything on your own. So being there is no backup, there is no family support. So being the sole breadwinner for you and your child, you need this particular life cover is another non-negotiable and a must. So ideal life cover. And when I say ideal life cover, take a simple life cover. Don't add frills to it. I've explained the concept of riders later, but that is not the frills I'm talking about. You don't need to take return of premium. If you're below 35 or so, the premiums may still be very affordable. So try taking a term cover as early as possible. The benchmark is it should be 10 times your annual income. But what I would suggest you having an approach is take your child's education requirement as well as for their comfortable living, what would they need up to a particular lifespan, and accordingly take a cover. Start low. If you're not able to afford a very high cover, start with the minimum of 25 lakhs or 50 lakhs offered by the different vendors, and then you could increase the cover as your earning capacity improves. Monthly premium options are available in a life cover. It is less training on our pockets. So do opt for it if you can. Monthly premium option will not put a burden on you also, and it is easier for you to plan. Include riders to mitigate future risks. So riders are basically a clause for which you pay an additional amount because of which your policy is not impacted. Okay, so there I've explained the most popular riders. You don't need to take all of them. You can select and choose the rider. Every rider has a cost attached to it. So given what you think is important at your stage in life and how you think things could go, choose the rider accordingly. Okay, so definitely there are one or two riders which is very commonly taken by our clients, and I'll speak about it when we come. Evaluate term cover requirement with changing scenarios. This is a point I just mentioned some time back. You may take a particular life cover now, but you keep evaluating whether this life cover is enough for your child in case of any eventuality. As they grow up, their requirements, their needs may change. So you need to keep evaluating it and keep topping it up if required. Some of the vendors have recently introduced products where you can also top up after a particular period of time. So just do your research, or you can go to any advisor of yours who will help you find such options. Be very cautious when I say life cover. Try taking a simple life cover with just the important riders. Don't go for, I personally would not advise a return of premium or such options because they unnecessarily increase the cost. When you're already going through certain financial emergencies and a difficult situation, there's no necessity to unnecessarily build up on your cost. So go for a simple life cover. Finally, whomever you go to, the advisor, try understanding their intent and objective, whether it's me or whether it's any other advisor. I would try understanding what is their objective. What is it that they would earn by selling this life cover to you? In the past, we have seen instances when term covers, life covers were pushed to the clients. So please understand the product, understand the objective of the person trying to sell this to you. This is very important. You are stepping into an arena, in case you're not already there, you're stepping into an arena where you're learning about how to manage your finances, learning on different aspects of personal finance. So this is another and very important skill, important lesson. It's good to have it at the beginning itself. The third one is nomination. Nowadays, whichever investment you do, whether it's through a bank, through mutual funds, stocks, you open a demat account, insurance, most providers on their own ensure that you provide a nominee name. Okay, so but in case technically a bank savings account, I've been given to understand you don't require a nominee, but make sure that you have a nominee for whatever financial investment or transaction you do where the money is at a later date is meant to go to somebody else. So some basic rules. Can you appoint your child as a nominee? Yes, definitely you can appoint your one child or two children, whatever be the case, you can appoint them as nominee. Can money go to a minor nominee in the event of death of a single parent? No, you need to provide a guardian. The rule says that it has to be a court-approved guardian. Try giving a very close family member whom you blindly trust and who you know will not mean anything, cause any harm to your child in case something happens to you. Choose your guardian carefully. Okay, so it has to be a court-appointed guardian. The money will go to the guardian. Okay, till which age can a guardian take care of the money that has come to them to be safeguarded? Only till the nominee turns 18 years of age, after which it will rightfully go to the child. Okay, it will go to the your child or the child. So now in case you've opted for both your children as nominee or three children as nominee, whatever be the case, while you're choosing them as nominee, you will specify the percentage share. So when they each one of them turn 18, accordingly, that share would go to that particular child. Finally, the fourth point, I'll again repeat, please don't compromise on your health cover, on your life cover, on nomination. If there's any takeaway that I would like you to have at the end of this session is the first 2 points, definitely. Please, these are non-negotiable irrespective of how you became a single parent. The last one is a will. Irrespective of your age, there are a lot of myths around a will. People think that only when you at a much later age stage in life, you should have a will. Some other myths are that I don't have enough funds anyway. Whatever you have, it is good to have a will to ensure that your assets, your hard-earned money goes to the right person after you. Okay, so have a simple will. Many lawyers will draft a simple will for you. Try getting it registered. Even if it is not registered, it has to be a given document is enough if it is working out too expensive. This is another very detailed topic, but do think about this. Whatever are your assets, if you have a house, if you have a few gold, whatever, make sure that you specify the name of the person to whom it will be going. Okay, who should try having your nominees in case you've opted for your children has the legal heir. Okay, so the will is the final thing which is a non-negotiable. So we have covered the first part of this, and that is what is common for whether you're a single parent by choice or a single parent due to life circumstances. Now we come to the second part, okay, where your financial dependence, financial standing right now may be different for each one of you. Okay, before that, I missed this point. The last thing that you need to do, this applies. See, these risk management tools of life cover, health cover, contingency applies to everybody, but it is all the more important for you. For a single parent, besides planning for an emergency expense, in today's context, you should also plan for loss of job and income. Many of you may be working in domains where you constantly need to keep upskilling. It is very, very important. If you don't upskill, we have seen with our own clients, with outside people losing their jobs. So please make sure that you constantly keep upskilling and you plan for both these unforeseen expenses as well as scenario, hope it does not happen, a scenario where you stand to lose your job. So there are ways in which you can invest for an unforeseen expense. You can try keeping at least 6 to 8 months of your monthly expenses in a simple liquid fund or a RD for a loss of job and income, which may happen at any time in future. Hope it does not, but you can keep it in fixed deposits or hybrid funds. So finally, now, as I mentioned, coming to part 2 of this. So part 2 is where you may either be financially, you may be having a stable income, you're able to manage the expenses for yourself and your child, comfortably, and if it given how we typically see, most men are financially stable income wise, so they may fall, single dads may fall into this bracket. Many of the women are working and earning very well, so they may also fall into this bracket. So that the areas that you need to focus on is slightly different for them. And those who have not been working, are dependent on some external income, there are a few things that it is good if you try addressing. So I will first focus on people who are dependent on some external income. The profile of such people are typically who have not been working, who have been thrown and into this particular life circumstance as a single parent all of a sudden. So what are the few things that you need to immediately address? You first have to create alternate sources of income. There are simple ways, which I'll be covering in the next slide, where you can create simple sources of income. All of us may be having some corpus. So there are smart and simple ways, which I will explain it to you. Whatever corpus you receive, as in case you receive an alimony or as a life cover because of the demise of your partner, spouse, try managing it in an appropriate way. So I'll explain what I mean by appropriate, and prioritize the existing loans, if any, where you're a joint holder for repayment. There are ways in which banks do help you to give you a moratorium, help you stagger the payments. So there are ways you can address, but if there is a very expensive personal loan or any other loans which are expensive in nature, a very high rate of interest, try clearing those first. So, as I mentioned, I'll first speak about people who are financially not independent and who are dependent on other sources for some kind of a living. So, first is, if you're getting some alimony, if you're getting some life cover, a lump sum amount, please do not keep all of it in your savings account. The bigger banks, most of us have a bank account with some of those very large banks. They do not give more than 3.5 to 4% on a savings bank. Why am I saying this? One, you don't earn a good rate of return. Number two, even the rate of return that you earn, if you take inflation into consideration, which is at between 5 and 6%, you're actually earning negative rate of return. So you're not helping your money grow. So don't park everything into a savings account. Protect your capital. It is very, very important. Reallocate this money smartly, either on your own or with the help of any advisor, into medium and long-term goals. So for you, as you do not have a current income, on a priority basis, park the first 2 years of your household expenses. You need to budget. That's another area which we'll be covering. You need to work on an optimum budget with which you and your child will survive comfortably. Park the first 2 years of your expenses, partly maybe the first year into a savings account and the second year into liquid funds. There are a lot of smaller banks which give you 7% or so even on a savings bank. They are RBI regulated, they are sound, good corporate governance. So you can also park your savings bank balance. You can open an account with such smaller banks and also park it there so that you earn a slightly higher rate of interest. You need to do all this. You need to learn all these skills so that your money is not idle and you are exploring all the ways optimally in which you can increase your returns. Regular expenses like your children's school fees, college fees, you can initiate investments in a simple mutual fund like a conservative hybrid fund where most of it is into debt, so your capital is also protected. Start it as a simple SIP from that lump sum, whatever you're getting, so that every year's education fees of your child is taken care of. Third, as I mentioned, clearing of debts, focus on clearing of personal loans in case you were a joint holder. In case of other loans, try speaking to the bank. There are ways in which they offer you a moratorium or you can delay the payment. Of course, there is a cost attached to it, but at least it will help you sort out other things meanwhile. create avenue. So if you're getting, this particular thing is, if you have avenues through which you can you need to generate sources of income, if you've received a lump sum as alimony or insurance, create avenues where part of your household expenses can be you also reinvest that money, and you are also generating some monthly sources of income. These are simple ways. One is a post office monthly income scheme. You get almost 8%, practically zero risk. You have corporate bonds is an area which many people have not explored or used. So you have monthly interest paying corporate bonds, where easily you can get maybe 7 to 9% kind of interest rates. Please explore that as an option and park, so that some stream of income. Many of these corporate bonds give you monthly interest, so you explore this option. Mutual funds have their monthly income plans. Then there is something called systematic withdrawal plans. You can park the money and you allow it to grow and take out only a particular amount, how much you may need for any particular requirement. So when you get this alimony, when you get this big corpus, don't fritter it away. Nobody fritters it away. I'm sorry to use that word, but try managing it in a smart way so that you are addressing at least the financial crunch part for the next 1 or 2 years. Okay. For those who have probably not received that kind of an alimony or a lump sum, and which is not sufficient, in case you have some properties or you have gold which was given to you because of emergencies, try monetizing it. Physical gold does not add any value. You can monetize it to create streams of income in future. These are tough situations that call for tough decisions. It is not easy. But in case you have not received any such alimony or in big lump sum payment because of what circumstances you're in right now, try monetizing your existing gold or any other investment to start with. You will build it up later at a later point in time. But to handle the current situation, this is one option that you can look at. Now, for this, this is for the, so we just covered for the people who are not financially independent. Even for those single dads, single moms who are financially independent, it is a reset on a lot of fronts. You have to do that kind of a budgeting, because you have to revisit your budget, because there are monthly expenses that may increase, especially in the case of single dads who are not used to a lot of the housework. I'm not generalizing, but this is typically observed. You may have to incur a lot of expenses for household help so that your child is taken care of properly. As I mentioned, insurance is a must. Your health and term is a must. So insurance costs may increase. So you can create a monthly income stream to meet those expenses also. Work on your taxes. If you're a person who's earning well, please explore this particular, to do a proper tax planning. The recent budget, I think new tax regime works by and large well for most people, and you'll end up saving to some extent. So if that's going to help you increase your take home, please do that. This is very, very important. When I say create a monthly income stream, I go back to what I said. There are simple ways. If you have some lump sum, you've received a bonus, try parking into these options, not very high risk. Do that so that you keep getting some income and you don't touch your regular salary for a lot of the expenses. Even for a financially independent person will also see a lot of changes in these three areas, in your household help expenses, in your insurance expenses. Please consider tax planning. You can reach me. I will provide you the calculator by which you can work out your taxes and determine which is the more effective one. As I mentioned, the recent budget is a lot in favor of new tax regime, but do your own calculation. Finally, a lot of single parents, especially single moms or even single dads, I mean, you don't know what has transpired to this situation. there's always a conflict between having a rented property, living in a rented property, and should I use that money for something else, or should I own a property so that I feel safe? Or if not anything, I at least have a house to back up, or tomorrow if something happens to me, my child at least has a house to back up. It's a tough call to make, and this is where financial planning comes into the picture. You need to decide on any big capital asset investment only after understanding what your goals are, how much corpus you would need, what is inflation, how do I prioritize the goals. Okay, I will show you both the calculation as well as the Excel. So don't blindly get into purchasing a property, and evaluate the pros and cons of doing so. Having said that, a home is an aspiration for practically everybody. I'm not saying don't go for it, but do it in brass numbers and then explore and see if it would work for you. So uh, most of us have this as a budget. So work out your different items of expenditure and see what is your monthly savings. That will also help you decide whether you can go in for a rented property or acquire a home or take a big home loan if required. Okay. Now we'll start with simple steps in financial planning, where I will also, as a part of it, I will cover the loan, whether you need to buy a home or you can live in a rented premise, after introducing you to the different goals. So these are, I've not gone into too much detail for any of them. These are simple financial planning guidelines that you can adopt. So what are the 4 simple steps? First, you will have short-term goals and medium-term goals. So first figure out which is short-term, which is medium-term, which is long-term. Short-term may be the next few years of your child's education expense. The medium term may be their graduation, post-graduation expense. Long term may be their marriage. In your case, it may be some planning for some immediate health expenditure. Long term may be retirement. So figure out your short term and your long term goals and expenses. Prioritize the goals. So when you prioritize, it'll give you clarity on where to allocate your resources. So when you prioritize a goal, there's a concept that I've mentioned in the next slide. There's a simple concept called core goals and aspirational goals. Core goals are where you can not compromise, like your child's education, their daily living, your retirement. Nobody is going to give you money for your retirement. So these are core goals. So have a clear understanding and perspective of that. Third point is inflation. Every item of expenditure, be it our children's education, be it our health cover, be it our retirement, every element has a inflation number attached to it. So as I mentioned at the beginning of our presentation, that health expenditures have gone up by hospital expenditures have gone up by 14% over the last 1 year. That's the steepest. Health and education are 2 of the highest inflation causing expenditure in our overall basket. So you need to plan for this. Finally, once you arrive at the corpus, you know how much you need to do on an annual basis or a monthly basis. What is the corpus you need? Having said this, any financial planning is an ongoing exercise. It is not static. It is not that today I give a number for my child's education, I can stick to that. I have to keep evaluating, because they also have their own dreams, their own desires, their own intent to do whatever they want to do in life. So we have to rework our numbers accordingly, as we are responsible for them. So as I mentioned, there's a simple concept: core goals and aspirational goals. You are responsible for your core goals. Once you manage to plan and execute for your core goals, is when you can move to the aspirational goals. Again, this is another point we covered: inflation. Please factor in education inflation, which is at least 8 to 10%, health costs, retirement inflation. If you want to have a vacation with your child every year, vacation expenses go up by 5 to 7% every year. So when you're planning your money, whenever you do that, so and you should be doing it at the earliest, factor in this inflation number. Fine. So the next step to financial planning is, you may be new, you may be currently investing. Understand the pros and cons of every investment avenue. There are plenty of them. Some with low risk like PPF, Sukanya Samriddhi. Some with moderate risk like your ULIPs, where you have an insurance as well as you can choose which particular scheme you'll invest in. Very high risk like pure equity mutual funds or stocks, direct stocks, or alternate investment funds. So, or the other way to look at it is also cost based. ETFs are low cost. Your national pension scheme is low cost. So there are a lot of things that go into selecting an investment avenue. It's a beautiful learning exercise, while it will take time for you to understand the tax implications and whether it's going to help you, how is it going to help you before getting into it. It's very important to understand the risk profile of these investment avenues as well as your risk profile. Okay, which is what I'm saying here. Understand your risk profile. You may be someone you who's not expecting very high returns. You're happy with maybe 7 to 10%. You have a different set of products. Someone who wants their money to grow at least 15% and are willing to take the risk, your basket of investment avenues are different. Understand your risk profile of the investment products that you wish to get into. Now we'll cover the most important thing for a single parent, and that is to ensure that they meet the financial child education expense of their thing. So here we have taken an example of of their graduation expenses. And this I've just assumed for an illustration purpose. I've assumed that this is a simple 3-year graduation course. If you go to a normal college, I'm based out of Bangalore. If you go to a college in Bangalore, it would not be even this expensive, but you don't know what your child is going to do. They may do engineering, they may do medicine. So I've just for illustration, assuming that today's cost, your child will need this stream of fees to be paid in 20, 34, 35, 36, which is 10, 11, and 12 years away. Okay. Today's cost for this, whatever the child you have aspired for the child, is 10 lakhs every year. That 10 lakhs, assuming an education inflation of 8%, will be 21 lakhs, 23 lakhs, and 25 lakhs in the 10th, 11th, and 12th year. Because it's not going to be the same 10 lakhs because you're factoring in inflation. As you can see, it's such a steep increase. And I would like to emphasize that I've assumed the lowest rate of inflation. Typically, if you see, when we do financial planning, we are witnessing at least anything from 8 to 12% a year-on-year increase in education cost. You have seen it yourself. You have never seen a reduction in your child's school and bus fees. Okay. So a simple 10 lakhs, 10 years down the line, today's cost will be 21 lakhs or almost 22 lakhs. 10 years down the line, assuming whatever money you invest, if you invest it at least 10% every year. So if you are going to invest it at 10%, it has to be a blend of different instruments. It can't be only in equities. It has to be, and given your risk profile, you have to manage it in such a way. Assuming you do a monthly investment of 11,289, see the first row, you will be able to meet the corpus. So it's a huge investment that goes into your children's education requirement. Okay. So first arrive at the year of the goal, stagger it. Any course is going to be at least 3. Today, even graduation, I think as per the new NEP policy, is 4 years. So stagger the requirement. Every year, you don't need the entire amount in the very first year. So first year, second year, third year, fourth year, stagger your requirement. Assume an inflation number, see how much your expectation is, and then you can arrive at how much monthly investment. So if someone fits into this particular requirement, they need 10 lakhs 10 years down the line. This is the kind of investments that they'll have to do to just meet their graduation goals for their child. So this works out to almost 30,000 per month. Your investments at a blended rate, which you can liquidate at the time of their college education, should be earning a return of at least 10%. Just a second. Yeah. What are the investment avenues that you can look at to plan or prepare for your child's education? There are very easy ones that can be opened just by sitting on a table like this and opening your bank account. or you can visit your closest post office. Very, very easy, simple ways depending on your risk profile. These are the different options you can look for planning for your child's education goals. Okay. The most easy and the best, one of the most recommended by us is Public Provident Fund and Sukanya Samriddhi. You get 7.1% and 8%. Both are tax-free. It is very unlikely that the government would meddle with the tax-free status of these two investment avenues. So if your girl child is below 10, please open a Sukanya Samriddhi account for her. PPF you can open at any point in time for your child. And once they reach the age of 18, you can change their KYC and it can continue in their name. Endowment plans or money back plans are simple ways. While I'm not a big fan of such plans, for a single parent who's going through the current situation, they may work for you, because a lot of endowment plans have regular inflows coming in at different periods of time. So this is one option that you can look at. ULIPs, unit linked insurance plan. There's been a lot of regulatory changes in ULIPs, so it's not as expensive as it was a few years back. ULIPs is a very good investment to both grow your corpus, at the same time have insurance on it. Okay, so explore ULIPs as an option. You can choose these schemes based on your risk profile. It will give you on a constant, on a long-term basis, you can expect 8 to 12% kind of return safely. So, and you also have backup and insurance. ULIPs also give you a waiver of premium option. The fifth one is a simple mutual fund SIP. The best and the most effective way to grow your money. You must be reading in the papers how a month-on-month SIP disbursements have been increasing. You start with whatever the amount. You can start with 1,000, you can start with 1 lakh, you can start with 30,000. There is no restriction on the amount. Do what you are comfortable with. Try stepping up the SIP so that it is you also manage to grow your corpus. One option I've written here is guaranteed tax-free income. You can use an insurance very effectively to meet recurring regular expenses. So just in case, as an example, if your child is between less than 5 years old, these guaranteed tax-free income options, if you pay premium for the next 10 years, up to whatever amount you can afford, they will give you practically double the amount for the next 10 years. So you will have it, you will be prepared to meet some college or some school expenses of theirs on a regular basis. You can reach me or you can reach your advisor to understand more on this. This is a very smart way of, and at a very low risk, you're planning for regular expenses of your children's education that will be coming in. So please utilize this in case, especially if you belong to a lower risk profile category. Corporate bonds, I mentioned earlier also, they're a great way. It is not explored in India much. Corporate bonds are a great way to generate a monthly good return or a monthly interest income, as well as to map your requirements. Suppose your child's education is 10 years down the line. You can take a bond, a corporate bond with cumulative, where the interest also accumulate and it reaches about 20 lakhs with maturity 10 years down the line. You go to any advisor or you explore it in the market, secondary bond markets yourself. Any of these trading platforms have started trading bonds in a big way. You will find something matching your goal year, which is 10 years down the line, 20, 15 years down the line. So you can buy a corporate bond. That way your capital is also protected. You are accumulating interest returns on it at a very good 7 to 9% kind of rate. And at the same time, you're getting the money when you need it. Then exactly at the time of maturity, the money comes to your account. So there are plenty of options for planning your children's education. Try having a blend of it, not just one, because children's education will require a huge corpus, especially if you have aspirations to send them abroad and all that, something which we will cover. So this was an example which I gave just to illustrate. If you want to go in for a simple graduation in India, many of you have aspirations to send your child abroad. Today, there are two types of locations. You have those premium locations and the second rung of locations. Premium locations are typically considered US, UK, Canada, and even Australia, Singapore. And if you go to the second rung, it's Germany, France, the earlier USSR countries and all that. The cost could be anything between 1.5 crores to 2.5 crores over a 4 to 5 year period. It's really expensive. Okay, in the premium locations, it's easily 2.5 to 3 crores. In the second rung of locations, it could be anything from 1.5 to 2 crores, and this 1.5 to 2 crores is over a 4 year period. You must be having your own aspirations for your child, that they should go abroad, that they should be doing this particular stream. So if you wish to plan for it, it is an you need to start early, and it is a quite an expensive affair. So this, just a second. Yeah. So the second slide, this particular slide says that if you have aspirations to send your child abroad, and given, assuming the current age of the child, this is just an illustrative example. You can reach us if you want to work out specifically for your child. This is assuming your child is 5 years and education inflation is 7.5%, and you need the money. I put 17 years. Why have I put 17 years? Typically, we tell people that you should have the corpus ready 1 year prior to the goal year. If your child needs the money when they turn 18, make sure you have it when they're 17, so that the money lies idle or in a very safe place with capital protected for the next 1 year, and you're able to meet the goal. And assuming your money grows at least 10%, as you can see, if you fit into this criteria, if you want to send your child to US, UK, Canada, or one of these premium locations, you'll have to do at least 1,67,000 per month. Here there is a big assumption. I've assumed that you have not done anything till date. I'm sure you have already invested, you've started your investments, and there's a lot of you have already done. But in case you have not done, this is how much you will need to be doing. Yeah. So we covered child education. Very quickly, I'll run through retirement planning also. So retirement planning, assuming for a comfortable living, you need 75,000 per month this year, and your current age is 35 years. Your retirement age is 60, and assuming your life expectancy, typically when we do financial planning, we take life expectancy of 85 years for most people. At the age of 60, you need a corpus of 5.83 crores. Okay. And assuming you have not done any investments towards your retirement planning, you should be starting with a monthly investment of at least 75,000, provided you're 35 years old. The numbers would slightly vary here and there, depending on your age, depending on how much you've already built as a corpus, what you want to take as life expectancy. But this is just an illustrative example. And this is also to just drive the point that these bigger, longer term goals require a much bigger corpus. I'm again emphasizing why I'm focusing on this is because the entire conversation about financial planning started with you determining, should I rent a house or own a house? Nothing wrong in wanting to go in for an own house. You just do it as an informed choice is what I'm trying to drive at. A goal like a retirement and child education requires a big corpus, big investments. You will be earning well, but you need to have it put down in numbers so that you take an informed decision. So what are the choices? So as you can see, this is a big amount that we need to be investing every month so that we maintain the same lifestyle even after retirement at the age of 60. What are the different avenues that we recommend strongly for retirement? PPF is included in this also, one of the best investment avenues. So please make sure out of your monthly investment budget, put something into PPF every month. Employee Provident Fund, your organization where you work gives you simple and very easy ways of investing on a regular basis and ensuring that you build a very big corpus. A lot of our clients we see are able to, with reasonably simple living, are able to manage their corpus just by putting into EPF, PPF, and NPS. They're 8% tax-free, 7% tax-free. without it being touched, without any redemption, beautifully builds into because of the power of compounding, beautifully builds into a very big corpus, and it meets almost 60 to 70% of their retirement expenses, corpus, what they need at that point of time. So if your company is giving you the EPF facility, NPS facility, especially employers contribution, which in today's context under the new tax regime you can claim, please go for it. Other options are ULIPs, your mutual fund SIPs. We have already spoken about it, so I'll not revisit. Again, guaranteed tax-free income options. I said this for the child education also. You can look at guaranteed tax-free options as a very good retirement planning tool. How it works is you pay a premium for a particular period of years and you get regular cash flows. The return is only 7%. It's absolutely tax-free. The intent is to hedge your future cash flows. There should be some part of your future cash flows that should be guaranteed and safe. So if somebody is telling you, if you go in for this product and they tell you that you will get 20,000 every month, you will get the 20,000 irrespective of other market risk or interest rate risk. So for retirement also, these are very safe, depending on the thing. The first two are very safe. There are different avenues depending on your risk profile that you can look at. Some things that you need to keep in mind. So I'll just show you an actual working. So our whole topic came because we had to figure out where should you buy a house or should you rent a property? Now, assuming you buy a house and your loan comes to about 58,000. So for here, I've just taken a sample assumption. Assuming you take a loan of about 70 lakhs and you take a loan for about 20 years and your rate of interest is 8%. Your EMI works to about 58,000 per month. Now coming to your household budget, this is just some illustrative examples. For each one of you, the numbers will vary. Assuming I have put a loan repayment, you're left with only net monthly savings of about 32,000. I have not included any SIP, any other investment here. These are just normal monthly expenditure that I've taken into account, and I just randomly put the numbers. You can do your own calculation. You will not be left with enough money to meet your child education goals and retirement goals, two areas of life where you cannot depend on anybody else. So what, again, I'm driving the point that work out your corpus numbers, do that particular financial planning, and then that will help you decide, should I wait before I purchase a house? Because these two are non-negotiable. They are core goals and you are the only one who can do it for your child. So make sure you put it down in numbers and then evaluate whether I have the ability. Now, if I take out this home loan and I put a rent of probably 20,000 in, if you go in for a comfortable living, your net monthly savings increases to 70,000. So you at least have money to invest for one particular goal of yours. So take an informed decision. Go to an advisor or try learning the financial planning process on your own so that you accordingly take a decision. So we've arrived at the corpus and we have determined where we will allocate which money, some guiding principles while we are doing our financial planning. You may have heard this a lot in the media. There are a lot of personal finance website. Please use the power of compounding. Compounding is a great tool. You will see the effect of compounding coming in only after the 7th or 8th year. So stay put, stay invested. Don't take out your money until and unless it's really necessary. And to do not take out your money, one simple rule is you start with only how much you will not require. Maybe it may be as small as 1,000 rupees SIP to start with. Step it up. There is one more thing that I would like to show you, and I'll be very happy even if you take away this. Somebody who's starting with just an initial investment of 10,000, okay? Initial investment. If their money grows at about 10%, okay? Just a second, I'll just calculate this. Yeah, I'm taking this thing. Yeah. 31,000. They have initially started with thing. They step up their SIP every year by 10%. Look at the kind of corpus that will accumulate to. If you're starting by 1,000 also, 10,000 also, make sure we tell all our clients that you may not have, right, currently you may not be able to do it with a very big amount, but apply this step up SIP option. It's a very simple way. All our incomes grow by at least 5 to 10%. Most of us, a small part going into investments at the beginning itself will really help you grow a very big corpus. The other thing about power of compounding, if this SIP is 10,000, instead of I stretch a little more, I make it 11,000. Look at the jump in the corpus that you can accumulate. These are very simple tools, no rocket science, which all of us can do. No, you don't need to understand finance also to be doing all this. So utilize the power of compounding and start your investments with as small an amount that you can do. Second, I specified what investment avenues you can look at for your children's education goal as well as for your retirement. So try mapping. If it's an EPF, it is only for my retirement, I'll try not touching it. If it's this equity mutual fund, it is for my child's education, I will try not touching it. It's very important that at least in your mind, you know that this investment should not be touched until and unless this goal occurs. Okay. So match your particular goal to that particular investment avenue. The next thing is manage your debts. Try not having debts to income ratio more than 40%. Maintain your CIBIL score between 700 and 900. It is very important in case you need to take loans in future. Repay your high interest loans, manage your credit cards, and work out the numbers before you actually pursue an aspirational goal, which we saw just now. Stick to a good asset allocation that will help you diversify, reduce a lot of risks like your market risk, your inflation risk, your economy risks. Okay. This is a simple example. Again, it shows how a person who has a higher share into financial assets. So if you see the table 1, this person has 1,65,000 into shares and this person has 1 crore. So if you see an overall return on this person number 1, overall returns on the asset allocation, it comes to about 5.9%, but this person is earning about 8.5%. So between your overall asset classes, it could be your EPF, NPS, shares, mutual fund, physical commodities like gold and silver, your real estate. Try maintaining an optimum balance. Too much into real estate is also not good. Too much into equities is also not good. Very less into equities is also not good. So you will learn along the way. Once you get into the process, you will learn along the way. So try having an optimum allocation. A good benchmark to know that you're actually creating a corpus is if you earn anything more than 7%. So keep this number in mind and try seeing that when you put down all your assets, it should be crossing at least 7%. Good number. This is 8.5 is a very good number in case somebody is able to manage. Above 9%, that means you're really generating a corpus. Finally, you have some sources of passive income. If you have any property, if you can rent it out, try investing in shares so that for the future you create a stream of dividend incomes. Have some interest income coming in, tax-free plans like those guaranteed tax-free plans that I mentioned coming in. Generate and work towards, not initially, but over a period of time, work towards creating sources of passive income for you which when you reinvest will again grow. So that will help you create a very good corpus. Of course, every passive income avenue that you are going to invest into will also have its taxation impact. So try understanding that too. Okay. So these are broad things that I would like it, and I will be very happy if there was some takeaway for you from this particular session. So to just sum it up, if irrespective of the situation, once you make a start and have some process and structured approach in place, you will be able to achieve, you will move in the right direction. So apply some basic principles, and wishing you all the best.